Investment advisory services offered by Pryor McCormick Investments, an Alabama registered investment advisor. Securities offered through Stern AG Financial Services Incorporated. Member FINRA SIPC. Pryor McCormick Investments and Stern AG Financial Services Incorporated are not affiliated companies.
It's 5:35 or 36 actually. Welcome back into the show. Good to have you with us, Steve Pryor with Pryor McCormick. Like we said in here, to drop some knowledge on us tonight, talking about our pocketbooks, talking about our money, really our retirement, our savings. It's a crazy time out there, and we appreciate Steve making himself available on Wednesdays. It's a regular segment here on the show. We hope y'all enjoy it. We hope you'll call us because your questions are a lot of times better than mine. A lot of times they're specific. We'll get so far into it, but if you got something super specific, call Steve. Steve, you got through all that rain and made it in here. I wasn't sure you were going to make it tonight.
Yeah, I wasn't sure myself. When I left the office to come here, I didn't need a shave, and now I do. I need fuel and about everything else. But if I could make sort of a public statement here, just a service announcement. If the rain makes you think you really need to turn your flashers on and drive, say, one mile an hour.
1 mile an hour,
yeah. Don't do it in the extreme left lane of I-65. Please do not do that.
People just, they killed me with that. They
almost killed me because I almost ran up over them.
You can't see those flashers in this kind of downpour. It's and you can some, but, you got to get over it. Get out of the way.
Yeah, the ambulance I passed that had its lights on was at least in the middle lane. So.
Way to go, Steve. But you know what? You made it, and that's what counts.
I made it. Barely, but I'm here.
Let me reset real quick. It is pouring, and we do have a tree down across I-65 South, so if you're stuck in that stuff, y'all just chill out, keep the radio on, pick up your cell phone, give us a call. It ain't going anywhere. So, and I would love to give you a traffic report, but it's just jammed up all over the place, especially Birmingham Metro and the burbs over the mountain, Homewood, Vestavia Hills, Lakeshore Parkway, all that stuff's covered in water. Steve, I don't know where you want to start tonight, but you and I had a discussion before we got set up here during the break, and it's one of my pet peeves. It's a phrase I hear all the time when people compare gambling and investing, or the stock market and the lottery. And it makes me want to scrape my head on a wall. Sort that out for me. Why is it different?
Yeah, me too. It's funny you say that. Last week I was in some other kind of meeting, and one of the really smart guys that I know and appreciate, he's not in the investment world, but he made that same kind of comment. He said, why would anybody want to gamble in the stock market? And when I did the double take, and it's a good thing I wasn't drinking coffee, I'd done a spit take, he said, well, it is, isn't it? And, we hear that from time to time, and it's annoying on one sense because it's so wrong. It's wrong on moral and practical rounds, but we have to be careful, and we sort of need to address it, really, because we're losing something. It's sort of like kids being not taught to write cursive anymore. We're losing these skills and this knowledge, and I'm afraid we're losing appreciation for capitalism in general and the stock market specifically.
The only thing that made us a free superpower.
Yeah. Well, just when you look at it from the big picture, the moral picture, that's a great place to start. When you look at it, investing involves ownership and the plan of building something where everybody involved in the process. If you buy one share of a stock, you own a share of that company, and your money is going to help that company grow and pay salaries and provide goods and services that people want and need. That's part of what makes this country great, is what built this country. It is the only way to build a country, really. Gambling is completely, totally, morally in the other direction. You're not adding to anything. You are not buying and owning anything. You're putting money in a game that over time you're going to lose.
Or instantly you're going to lose.
And exactly, yeah. You might win this hand. You might win today or this weekend. But anybody who knows, you gamble long enough, all the house has to do is keep you gambling, and you will lose.
And that's the thing. Gambling is designed. I know this sounds ignorant to a lot of people to even entertain this thought, but people do have that mindset. Gambling is stacked against you in the beginning. That's how they built Vegas. Mm-hmm. The stock market, while I think the only thing they have in common is risk, because there's always risk. Mm-hmm. But it's an investment. You've got a reason. You can do research. There's a reasonable expectation for a return. You're not trying to win $425 million in some lottery, you're expecting to get your 5 or 10% or whatever.
Yeah, I will say one of the advisors that works at Pryor McCormick passed me in the parking lot, and he did say if he won the lottery, he wouldn't be
Is
back
he done?
tomorrow.
Yeah,
So,
he's pretty much done. Yeah. I think I'd come back in for one more day.
Hey,
So,
listen, yeah, I'd have a totally different attitude. The a lottery is, as I've always heard, is really just a tax on people who don't understand math. That's really what it is. And what you're getting at is the practical side. The moral side's obvious. Nobody wins in a bet. You know, even if you win, you're the only person who gains. But over time, as we all know, the house will win. You will lose. And but when you get to the practical side, I think one reason a lot of people think it's like gambling is that the way they invest looks a lot like gambling. You know, there's professionals in the business do a tremendous amount of research. They have all sorts of resources. They spend millions of dollars. They have talented people to look at this who have proven track records, and they know, they never know, but they have a great idea, educated guess what to buy. And we all know people, though, who buy a restaurant stock because they like the biscuits they make. Yeah. And there was even a commercial on television maybe 10 years ago where people were sitting around and they were watching a foot race go by, and a guy sees some snazzy tennis shoes, and he goes on his computer and he buys shares in that company.
Didn't know anything about the company, whether it's healthy.
That is
good
gambling.
Choices. Yeah,
that really is
that
gambling.
is gambling, I see.
Yeah, and even some legitimate parts of investing, like, for instance, options and futures, people have misused tremendously. For a good example is frozen pork bellies. Don't ask me why I know this, but one contract of frozen pork bellies in the option, the futures market, is 42,000 pounds of frozen, literally, pork bellies in a railroad car. Now, that is a very useful tool. Now, you can buy and sell options on that for future delivery, and all that means is if you're a bacon-producing farmer, then what you can do is kind of ease out the risk. You know you're going to have 42,000 pounds. You can sell one of those option contracts and know what price you're going to get. It's a useful thing. Along come people in my industry, greedy people that aren't in our industry, who say, well, you know what, that price really moves a lot. And I think there's just not going to be as many pigs around, and so the price is going up, so they speculate. They throw money into it, just making a bet. Now, that is like gambling.
That's a bet. Yeah, that's a hedge, so to speak. But the good side of that, though, as opposed to, say, the lottery, is at the end of the day, if you lose, you can still have 42,000 pounds of bacon.
That's true. You got to be hungry.
There's nothing wrong with that.
Yeah, absolutely, especially if you have sons the size of yours. So
I got to feed that guy, you know what I'm saying?
I can see 42,000 pounds may not be really all that much.
It's like a day and a half. So, okay, so you sort that out, and you try to educate people that there is a practical expectation that if over the long haul, which is the difference, again, gambling is more about instant gratification and doubling and tripling and quadrupling of your money, and that's not the kind of advice you need to get when you're looking at retiring.
Yeah, absolutely.
And your nest egg.
That's absolutely correct. You know, we're sort of on a mission at Pryor McCormick. We absolutely don't believe people should retire broke. There's no reason to. You can control how much you spend. You can control what you do with the money that you save. As long as you spend less than you make and save and invest the rest, then you have control. You can build something. That's what investing is about. Investing is not like gambling, but it's also not like saving. You know, saving is just putting it back. You put it in a jar in the yard, or you put it in the local bank or credit union in the savings account. That's fine. That's wonderful. That's a good thing to do to a point. But especially looking at the history. Well, let's look back. Why in the world do you need to take any risk at all? Because really, taking risk is the only way to make your assets grow. You've got to grow. You have to have at least part of your money have the chance to beat inflation. Now, looking back, if you look back, say, to the 1950s, 60s, 70s, in each of those 10-year periods, you got an average inflation rate for a 10-year period, something like 25%. In other words, if you started 1960 with $10,000, let's say $100,000 in your savings, and held that for the 10 years, and you still had your $100,000, well, the cost of living went up 25%. You had to make your $100,000 grow to $125,000,
or you're going backwards.
Or you're going backwards, exactly. And that's the problem a lot of people have right now. You put your money in CDs and things, And normally I would love CDs, but right now if you're getting less than 1%, and we know inflation, real inflation, not government core inflation, but real inflation is over 6%, you're losing 5%. And in 20 years, that's it. 5% for 20 years, you've lost all the buying power.
So the game is you got to have enough when you get to that point in the future, and you got to estimate what you're going to need. And that's part of what I guess y'all educate folks on too, because I noticed you were telling some stuff about what you just need for healthcare costs.
Yeah, absolutely.
When you hit 65. I mean, how do you figure that out?
Well, there are all sorts of really good think tanks, researchers, analysts, and things that have come up with the idea that the average American couple, that's two people, and they retire at age 65, that just for health insurance premiums and out-of-pocket medical costs, that's just the standard stuff. Now, medical insurance is going crazy right now, but just for that stuff, you're talking about, for the rest of their probable lives, you're looking at almost $300,000 just for that.
So people like me may take for granted the fact that those costs those are fixed costs, really. I mean, you've got to pay for that kind of stuff, especially as you get older. And if you take that for granted, you're not going to have enough when you get there.
Absolutely. The thing to remember is that a couple of things about inflation as people talk about it. Inflation, the way the government reports it, as you well know, I've heard you talk about, is core inflation. That means the cost of living, a basket of goods, but they take out food and fuel, energy and foodstuffs. Well, if you can live without eating or driving, then that makes sense. If you include those, like I said, last year's inflation rate was over 6%. But the other interesting thing, and we got people in this very room that this would actually affect, there are two groups of people that inflation is much higher than for the rest of us. One of us is young people going to school. The cost of education climbs much faster. And there have been stories in the news this week about tuition in some schools going up 10% just in 1 year. The inflation rate for people getting ready and going to school is higher than average. But the group that has the highest inflation rate are seniors. Because when you think about what seniors buy most,
your lifestyle changes.
Your lifestyle changes, and what they buy most is medical stuff. And if you've been involved with it yourself or maybe with your family like we're going through right now, you have to realize the cost of medical care, medicine, the number of medicines you need goes up dramatically, and you have a personal inflation rate much higher than what the government does. And the government reports this very small core inflation, and one of the reasons they do it to make themselves look better. The other thing is things like Social Security, which are supposed to adjust for inflation, don't have to adjust very much.
They never do, yeah. It's the government's got control of that, and they're not going to do it. You want to take some phone calls?
Absolutely.
I mean, you and I could keep that discussion going forever because I just want folks to understand what you need to be strategic. Here's Phil in Birmingham. He's first up tonight. What's up, Phil?
Hey, guys. Thank you so very much for taking my call. I truly appreciate it.
Yeah, man.
Really quick question for you, sir, if I may. With regard to investing, I actually have two questions, if I may. First, with people particularly who aren't very savvy in this world, okay, like you said, there's all these people spending millions on whatnot, trying to predict all this, that, and everything else. Then you have regular, everyday people like myself and my wife. Okay, now there's not much money that we live on. We're more of a paycheck-to-paycheck family, but we're trying to fix that. And part of what we would like to do, of course, is invest for, short-term and long-term. That said, one of the things I am concerned with, though, as well, is, of course, the dollar in our economy, particularly paper money and everything else. Now, what I see a lot of, a different note, is people saying, oh, well, invest in this company for gold, invest in this company for silver or bronze or copper, whatever it might be. Now, while I definitely believe in the metals and investing in them, what I get nervous about are these companies that say, yeah, if you invest with us, you'll have all this money in gold. How do I know it's really even going into any type of a precious metal at all? Wouldn't it just be smart for me to buy the precious metal, like you said, bury it in my backyard? Or no? I'd like to get your thoughts on that. Thank you.
All right, Phil, thanks for your call, man. Steve?
That's a good question. I think I got two questions out of that. The first one was, he said he's not savvy, and how do they compete with the big boys? Well, the really, really good news is, in the old days, 30 years ago when I started, all I could say was you got mutual funds. You can buy a mutual fund that buys U.S. large company stocks and that kind of thing. That's fine, except you still are making the big decisions. Should I be invested at all? Should I be in cash? Should I go in stocks, bonds, whatever? The really good news is in the last 5 years, technology and the development of the market delivery system has gotten to the point where you can now use the same kind of institutional money managers, the big boys, have always used. Tactical managers, managers who will do the same moves for you that they do with somebody who's got $25 million with them. And that spells out, for our clients. I just met with a client in Albertville this past Monday, and we were reminiscing about the October 10th, 2008, where we had almost $2 million in this annuity being managed by a manager. The manager got up that morning and just said he could not, he was, at 5 o'clock in the morning, he's exercising, and just couldn't think of anything he wanted to own. So he decided to pull everybody out. Well, he got all our clients into cash. That Monday started the worst week in the history of the stock market.
Wow.
And over the next 3 months, he saved our clients 25%. Now, can you imagine losing a fourth of your life savings in 3 months? Well, that's what happened to a lot of people in 2008.
So you're saying these managers that y'all have relationships with and you use the same tools, the same strategies,
thing.
and they are constantly guarding it. And you're not doing that yourself, sitting over.
I am not doing it. You don't want some knucklehead like Steve Pryor sitting
You're hiring
in Birmingham.
it out, making sure it gets done.
Exactly, and we manage the managers. Make sure you have it with the right managers. That's number one. The other question about gold and things. Gold is a commodity just exactly like the frozen pork bellies we just talked about. Mm-hmm. At times, it can be a good hedge against inflation.
Now, explain it, and I want to do some rudimentary stuff.
Okay.
Explain a commodity.
All right. A commodity is not a paper asset. If you own stocks and bonds, you're either lending your money to a company in bonds or you're owning a piece of the company. You own paper, and that's the way it is. Commodities are exactly what it sounds. They're hard assets. Commodities run the gamut from gold, actual real gold, physical gold, to frozen pork bellies, to plywood, to cardboard, to rice, to oil. When people quote the price of oil, they're not talking about the price that the local Chevron station paid for that truck that just rolled up. They're talking about futures delivery contracts down the road. And the spot price for those insiders, that means the current contract, the one today. Yeah. And so that's what they're reporting. And it's just the way, it's a great tool if you're a producer, if you're a company that does this stuff, you're a farmer with soybeans. How would you like to be a soybean farmer and you got all these soybeans, you're going to harvest them, and you'll have a big bunch of them September 1st, and then right before you bring yours to market, the price of soybeans plummets. Well, you can actually lock in the price for your September delivery today through the futures market.
So you can do your business and know you're going to have
your business product. And you know what it's going to be. Mm-hmm. And that's a useful thing. Like I said earlier, where that gets messed up is people get messed up. There's an old quote in the commodities business that says, "Pigs make money, hogs get slaughtered."
Yeah, you don't want to be the hog, right?
No.
So I guess his question was, you got these pitches, and we've talked about this before in this segment, where you got these people on TV telling you to buy physical gold, and you got folks that worry about an economic collapse and think they got to have their hands on it. Is it safe enough to have something on paper nowadays?
I think you have to be really careful who you deal with there for two reasons. For starters, I've seen people put too much money into something like gold because they're gloom and doomers. They're preparing for the doomsday. And I've always said, well, what are you going to do with a gold coin even, which is one of my favorite ways to own it if I owned it. So you get people who overdo it and own too much. They may have, $100,000 in their 401k, but they've got $25,000 in gold. People have to remember gold is a very aggressive sort of buy. It really goes up and down a lot. The first time gold hit $1,000 an ounce was I may be off a year, but 1981.
I think I remember that people were just turning into jewelry
long
and all
time
that stuff
ago,
when I was a kid. I remember that,
Yeah, that was the first time. And then it went 15, 18 years losing money.
Because it made that jump.
Yep.
Because of emotional
speculation.
The
Hunt brothers were trying to corner the silver market. I don't know if you remember that. You're too young, probably.
Barely. I remember the...
Yeah, and that made silver zoom up. And so, there's a lot of different reasons, and we actually have investments where we have managers who will buy gold. But that's the way to do it. Let a professional do it. Don't think of gold as anything different than any other kind of investment.
And the professionals that you use, they're going to know based on your risk tolerance. In other words, people my age, sort of in their 40s, people AJ's age, quite a bit younger, or even, close to retirement, what your risk tolerance is. and how much of that you can take in that overall
Hugely
spread,
important. Absolutely. That's the way they manage. They manage it to a certain level. Like, for instance, when we manage people's 401ks, we don't do it. We put it in the hands of a professional money manager, one particular we use is in Seattle. They will watch it on a daily basis, make the changes that are required given your risk tolerance. And that's the important thing. How much risk do you want to take? And how you think about risk really determines how you manage the money. I heard this about a month ago. A guy was saying, all right, I've got a game for you. I want to say, here's a game. It's a high-stakes game. I promise you, guarantee you 5 times out of 6, that percentage, you will win. You will win the game 5 times out of 6. Would you play that game? Most people say, yeah, no problem. Until you tell them it's Russian roulette.
It depends on the day.
You got to watch what the loss is going to be.
Right.
And that oversimplifies it a little bit, but that's really one of the most important things you can do.
So what are the common mistakes, again, from a very just early approach, people that aren't doing this on a daily basis? What are the common mistakes people make in guessing at what they need, guessing at where you are now? And a lot of folks aren't in a good place. We just had a bad recession, and a lot of folks are still got it under the mattress or playing defense. But what's the mistake we're making right now, you think, as a whole?
Well, it is human nature. Everybody wants to do today what they wish they had done a year ago. Right now, the market's been on a roll. You know, it's doubled in the last 5 years, and it's been a steady growth, a steady crescendo of people who come to us and say, I want to take more risk because I see, you know, the stock market's up 20%. I want to take more risk, more risk. They're always investing, as Warren Buffett has said, when you're looking at the economy, you know, driving the economy car, it's like driving with a rear view mirror that is the size of the windshield. Everybody's looking backwards.
Yeah,
instead of
big
forwards.
time.
Very
Looking the other
difficult to look forward.
Let's. The music's playing. Can you hang around again? I made you do
Sure.
that last time. You got time? Hey,
Be
you're not
happy
going
to.
anywhere. Traffic's bad out there anyway. I have some questions about a couple of more things. We'll take some more calls too if y'all have some ideas about your own situation or just some stuff you want to ask Steve. Steve Pryor. The firm is Pryor McCormick. You can go to 401ksanity.com. Is that the best site you want people to hit?
Well, PryorMcCormick.com covers the whole gamut of investing, and 401k Sanity is strictly for people who want help with their 401k.
And we'll repeat all that when we come back. Steve's going to hang around with us a little bit longer. I got some more questions. I love helping folks try to figure it out, trying to build some confidence. We got it. It's up to you. Nobody's going to do it for you, I promise you. And with whatever you got in your nest egg, Steve Pryor and the folks at Pryor McCormick are the folks that can give you some sober advice, and that's kind of what we all need right now. It's 6 o'clock. We'll take this break. Back in a minute. Stay tuned.
Gather round your radio, it's time for Leland Live. Tell all your friends and your mom and them all about Leland Live. Just rolling along on your long way home, everything's gonna be alright. Just let it slide on the afternoon drive, time for Leland Live.
Well, it's 5 minutes after 6 o'clock. It's been an interesting afternoon. We've talked about everything under the sun. We've talked about guns. Let's talk about the weather for a minute. Steve Pryor with Pryor McCormick. I'm going to get him to hang around a little bit longer. Good partner with the show and just a smart guy, cool guy. I like your sober sound advice. He's giving me a thumbs up now. How's that? Steve just calms me down. I get worried about my own money. You worry about your money, AJ?
All the time.
I ain't got my mind on my money on my mind. You know how it is.
Mm-hmm.
And it just being around Steve makes me feel like, okay, I can do this. I can make this work. And we hopefully that's what the audience gets from our conversations too. Before we do anything else, Steve, I want to talk a little bit about the weather situation out there. We've got some serious flash flooding. I'm starting to see some photographs being sent in here from Vestavia, Homewood, all over that over what we call the over the mountain region in the Birmingham area. Still a flash flood box over just total Birmingham Metro along 459. Y'all need to be super careful. The traffic maps are just a mess right now. It's going to take a little while for the traffic to clear. This thing dumped on us right at rush hour. It is all moving toward the south. The stuff that was in Birmingham Metro, there's a lot moving toward the east now too. So folks up the 59 corridor between Birmingham and Gaston, pouring rain. Be careful, watch out. And then out to the west, you know, our listening area is so large we have to kind of go all over the state to look at it. We've got folks over near Franklin County, and over just on the other side of Fayette County to the east of Fayette County, pretty good sell out there too. This stuff's starting to calm down for the night, but we're just this has been the wettest, mildest summer I can remember in a long time. But we have to deal with this stuff on a daily basis. Just need you to know that as you're out traveling. Just be patient with the traffic because you're not going to get there any faster by honking your horn. Just pay attention. Sit back and listen to us for a few minutes. I want to continue with some of these questions in this conversation. I get enthralled with some of Steve's advice. Steve, you got a lot of folks out there. We're watching the markets today. A little bit of a drop today. A lot of that's back to that same conversation we've had. Bernanke comes out. He says the T word again, which is taper, which means the government finally getting out of this propping up the interest rates game. And you see the market instantly react. Do you think we're going to baby step this thing back the other direction, or how's that ever going to work out?
I do. You can't buy $82 billion worth of treasuries every month. You can't take that much money from one pocket and put it in the next pocket for indefinitely. And that will have to slow down. I think at some point we got to kind of come off the drugs, and we're going to have to come back to reality. The federal government has held interest rates artificially low for a long, long time. And there's an argument about whether we've done it too long. But the most troubling thing is when I hear serious, sober analysts bring in the idea of the election cycle. That
I know it.
The Fed would actually manipulate interest rates and hold off doing what they think they should do just to get the current crowd reelected. And by current crowd, I mean all of them.
All of them, both sides.
Yeah, both sides, exactly.
Because a bad economy could be fruit basket turnover, and they're protecting people that have a lot of checks get written in Washington, and it is government policy.
Yeah.
Is that dangerous? I mean, when people say the market, and I'm guilty of this too when I talk about things on the show, because I'm not a stock market expert, but I do watch the Dow and the NASDAQ on a daily basis. But there are stocks within there, and there are stocks market-wide that either aren't part of that component or individually they're just good companies, good buys, and it's where the money managers know to go. Are there stocks out there that are independent of this chaos?
There are always stocks that swim against the stream. You always see, every day if you listen to the stock market reports, you'll see the gainers outperform the losers by whatever percent. There's always companies going in opposite directions. And it really comes down to investment style, not to get too far deep into the weeds, but it's your personality, if you want to think of it that way. There are two kinds of stock investments. There's the growth kind. You buy a company that's not making any money, never made any money, maybe a new company, may have some brand new computer widget, and you're betting on the come. You are betting, to use terminology, that it's going to produce. There was a time in the late 90s when Microsoft, one of the darlings back then, their PE ratio, people were paying 200 times what the company earns in a year to own that stock. Now think about that. That means if the company just kept the same earnings they had for that year, you would have to own it 200 years just to get your money back.
Just to get back to even.
Now that's growth investing, and that's kind of a go-go. That's looking in the future. Then the other kind is me, my personality, is value investing. You find a company that's worth more on the hoof, so to speak, worth more as it sits, its assets, its business, than it's currently trading in the market. And they get that way because maybe they're not the sexy, darling kind of, internet company that everybody loves. It's just a standard. It's more the Warren Buffett way to buy things.
So look for value, and these managers, they're looking for a valuable stock. But that's yet again another one that you, I guess, want to buy and hold because you're going to get in on the low side and you got to wait on it.
Well, yeah, buy and hold is really a great conversation to have. There was something called the modern portfolio theory that was put forth in the 1950s that said, here, this is a way to manage your risk. You can manage your risk by putting X amount in stocks, which are considered risky, and X amount in bonds and a little bit in cash. And you adjust those, and there you can adjust your risk. If you really want to be risky and make a lot of money, have a lot of stocks and a few bonds. Modern portfolio theory, a lot of people use that, but it was never more than just a theory because we had essentially the market going up. Just going up all the time. And from 1979, the first day I sat in an office in Birmingham, Alabama, as part of the investment world, the Dow Jones Industrial Average was 800.
Wow.
Not 8,800 or 10,000. It was 800.
And 1,000 was earth-shattering.
Yeah. Oh, yeah. Yeah. And it had spent the last 10 years coming down from 1,000.
Right.
So to say the market was depressed is putting it mildly. Almost anything you bought back then was of value. It had real value. And then the market grew at 18% basically a year for 20 years. It was a great time to be investing. It's been tougher lately. That modern portfolio theory I mentioned really doesn't work, because if you think back to 2008, everything went down together. The technical analysis was
all of it. Yeah.
the only thing that goes up in a bad market is correlation, which means when things go down, everything goes down.
Do you have that flexibility still? And you talked about going between, like shift over to bonds for a while, maybe go back and get a little money in the market and get back out, that balance. With the bond markets being so weird now, what just happened with Detroit, for example? I heard a story today that New York, even the mayor of New York right now is telling people we're the next Detroit if we don't deal with some public policy issues now. A lot of it's retirement promises in New York. Chicago's on that list. We got major American cities with a lot of liability hanging out there. So are bonds still a go-to? Can they still be trusted in a go-to place?
Well, they can. Let me just make a statement there about Detroit. You know, there's a challenge right now, legal challenge to the Chapter 9 process, saying in Detroit, in the state of Michigan, you cannot curb pensions. You have to leave them alone.
It's codified. They have to.
That's
off.
what one side says. The other side said, well, we only have to do that's already established. And I'm not an attorney, I don't know.
Right.
But if that passes, then every bond of every in-trouble municipality in the country is going to suffer for it, because that means you can't go bankrupt and solve your problems. You will still have the major problems, which is all the pension plans you have to pay old employees.
So you're talking long-term
Yeah.
legacy costs to cities and states.
Yeah, absolutely.
And Alabama's sitting on a pile of liability, too, long-term, because of some of the employee programs that were committed 2 years ago.
Absolutely.
And I know there has to be fairness between these employees and what was promised versus what's there, but you know, these are governments. They don't go out and produce anything. They confiscate money.
Yeah.
And it just seems to be a dangerous long-term scenario without some back to politicians, without some real leadership on this issue.
Yeah. As Van Morrison said, it's a hard road, Daddy-O. You got to pay attention to it. The old days where you can buy and hold, something you mentioned a while ago, just buy quality companies, quality investments, and then just forget that you own them, just buy them, and you wake up 20 years later and it's worth a lot more. It's just not true anymore. You have to be more active. You have to have managers, in my humble opinion, who will get out of the market when they see bad times coming. You know, if you own a mutual fund, and there have to be a lot of people listening to us right now who own mutual funds.
Sure.
Read the prospectus. That's that phone book size thing you get that nobody reads.
Nobody reads.
Including the guy who sold it to you.
Right.
Look at that. If you have, for instance, a growth, U.S. blue chip stock growth mutual fund, then by law, the government says they have to always be at least 90% invested in what they say they invest in, which in that case would be large blue chip U.S. stocks. Now, let's go back to 2008. You're trusting these managers of this mutual fund to buy you the right stocks. But let's say they're genius and they saw the big crash coming. Well, what could they do for you? They could take 10% of it out of those stocks and put it in cash, which some of them did.
Wow.
And they have to stay 90% invested in those stocks. And so some of the best in quotes, mutual funds, growth mutual funds, lost over 40% in 1 year, almost half your savings you had with them. And so that buy and hold stuff really doesn't work. And that's happened twice in the last 13 years. We've had the stock market lose half of its value 2 different times in the last 13 years.
So let me straight up pitch Pryor McCormick. Let's just
Well, I
say,
appreciate that.
What y'all do differently there is you've got independent money managers that have all that flexibility to take your nest egg and play defense with it, as opposed to being locked into a prescribed formula.
Yeah, that's a great point. Playing defense is a big issue. Being a big Alabama fan like I am, I'm appreciative.
There's one in every room, I swear. That's all right, I got you.
I think that's a lot, too.
I'll give you a roll tide. Go ahead.
Yeah, thanks a lot. I appreciate it. Just get ready this year.
My son just looked at my Auburn student over here, just gave me the dirty look. I said, you said what? What did you say?
I don't know you,
That
Dad.
was politically correct. He wants a DNA test now.
Enough of that. As far as that's concerned, you have to look at what's coming down the road. You have to have managers, and they're not going to always be right.
Right.
They're not going to make the right moves all the time, which is one of the reasons you need more than one of them. We put together a model at a certain, as you mentioned earlier, risk level, say a moderate risk level. We have 5 different managers inside that model. 10 years ago, we could not do it. The technology didn't do it. The platforms to do that kind of thing did not exist. But that's one of the big benefits. Yeah, it's a tough road out there right now, but
so we
have the tools to deal with it that we never had before.
You have a high-risk sort of guy and
Absolutely.
and a I'm about to retire low-risk kind of guy that
Absolutely.
will handle those type products.
Yeah, that helps. But a lot of times we'll have a guy who's within, say, 3 years of retirement, and some of his money needs to be very safe. Some of it needs to be moderate, and he may want to take a little bit and put it out on the aggressive end. Matter of fact, when we say using a scale from 1 to 10 of risk, if you're a 5 on the risk scale, we may have none of your money with 5 money managers with that risk level. We'll use the barbell approach. We'll have some 2s and 3s, and then we'll have some 6 and 7s. Because any given day, you don't know which side is going to do better. And you've got to cover the waterfront. You've got to have at least, as we said earlier, at least some of your money have at least a chance to beat inflation.
So you're pretty convinced there are folks out there listening right now with a decent nest egg that maybe in some company program they have just always been in.
Right.
That think they have no flexibility, but there are provisions that may allow them that flexibility to convert or put things in places where they've got more control of it. It's not just tied to what you've always been tied to.
Absolutely. That is a great point. That's sort of the mission that I mentioned earlier. If you've got a 401k with a meaningful balance, you can get help. Even if it stays right there, you can get help with how that's managed. And in many cases, half the companies in America, we can actually put a money manager directly inside your retirement plan, and they can manage it for you at your risk level. Again, they won't always be right, but at least, what would you rather have? You, who never look at it, you get your statement, and most people don't even open them.
Yeah, they're scared to open it now.
Yeah,
So.
and they've been told for years by our industry, hey, just don't worry, trust us.
Right.
Anytime somebody tells you to trust them, that's when you grab your wallet. And that's why we put money managers in there who aren't just asleep. I don't want to say asleep at the wheel, but they're active.
Some of them have millions of accounts.
Absolutely.
Not yours, but in the other programs, they've got all these people locked in.
Yeah.
I don't know how they would possibly keep an eye on my stuff.
Yeah, no kidding. And it's even worse when you get down to the local offices. For instance, wirehouses, and I won't name any, Merrill Lynch, but there are many ways like a car dealership, like a GM, like a Chevrolet. Product for cars is manufactured in Detroit, of all places, and other places, and then it's sold and distributed locally. The same thing happens in our industry. Large companies that you know the names of, they manufacture actual product in New York, and it's sold locally. That is the hard truth. And if you don't believe it, just find somebody who is a stock broker, somebody who is a securities salesman, and ask them about it. When I first got into business in '79, that was it. I was at Dean Witter Reynolds, and they would have things like Monday pizza night because they would take down some extra shares of stock. They would provide the beer and pizza, and we were supposed to call people out of the phone book and sell them stocks.
Just like a product. Just
absolutely. That's absolutely what it is.
Come kick the tires. You're going to love this car. And it's yours.
Yeah, and more to the point, there's really, and I hate to say this, there's nothing wrong with that as long as you know that's the proposition. As long as you know, the investor
knows.
Yeah, as long as the investor knows. That's the problem we're having right now. The regulators say that variable annuities, are good for some people, bad for others, but there are an awful lot of people out there selling variable annuities. And they have to be sold. Nobody wakes up in the morning and says, I think I'm going to go buy a variable annuity today.
So just put it in plain English. I call somebody, I need some advice. But the minute they pick the phone up to answer my question, that they've got a product they're going to try to sell me right
exactly.
off the bat, no matter what I need to do.
I have no problem with anybody who says, look, I sell variable annuities. I sell mutual funds, whatever it is. Do you want any? Or how much do you want? What bothers me is when they say, I'm an advisor. Let me look at your financial situation. And it's just, for some reason, they end up putting all the money they get to invest into variable annuities.
Is the key word here independent advice?
I think so.
Where you're not locked into one particular
That's huge. That's another little watchword, and we need to do a show on this, is just how to deal with the investment professionals. The questions we have. We got 3 pages of questions that we'll send to you for free for anybody who wants questions to ask.
Is that on the website?
It's not on the website. It's something that we can put it up there. It's not a big deal. As a matter of fact, we'll do that. On the homepage of the website on the right-hand side, right under the radio part, where you can listen to the previous week's shows, by the way.
Oh, yeah, that's right. You guys put those
right
up.
under that, there's the 5 latest hot topics, and they're links to different places, and I'll put a link to that up there this week.
Is this on the Pryor McCormick site?
PryorMcCormick.com.
All right. And just to reiterate, because we've got to hit this break, Steve, I appreciate you staying overtime with us again.
Oh, I love it.
I get fascinated. I could sit here all night because I just learn, and it's given me perspective. Or I can't help it. I'm selfish. I'm thinking about my own situation, you know. But the audience is out there doing the same thing. We're all sitting calculating in our minds and walking through this stuff because we want to get confidence again, because we all want to retire. Nobody wants to be we don't want to surrender to bad public policy out there now and having to fight our own government to survive in our old age, and we have to be strategic. And that's why I appreciate your advice.
Well, listen, we're here for a reason. We had tremendous respect from you when we got to know you a few years ago. I've always followed your career. You're the best out here. And we really do feel this is a public service. I know your radio station's a business, but what a great situation where your business is making the world better for folks.
Wow.
And I hope I'm not overstating that. But
we need to light a candle now.
We appreciate what you do.
Yeah. Okay, look, Steve, let's give everybody the numbers again. Pryor McCormick is Steve's shop, and you can go to our website if you already know ours and find a link to theirs. But how do folks reach you on the web and your phone number and all that?
Phone number is 1-800-800-8761. 800-800-8761. Locally, 205-986-0060. It's PryorMcCormick.com. And if you want to look at our specific to 401k help website, it's 401ksanity.com.
All right. Steve Pryor. See you next week, man.
Yes, sir.
Steve Pryor, Pryor McCormick. Back here in a minute.
Leland Live on Superstation 101.